Hi, in this video we are going to talk about an overview of what cost of capital is. So before we start, it's very important for us to understand what is capital. So today we are going to talk more about what is cost of capital. But before we proceed further, it's very important to know what is capital. There are two types of capital in general. We can either raise funds through debt, borrowings, or we can use equity for capital financing. Okay, so when it talks about equity, there are two types of equity. It could be either what we call the preferred stock or the common stock. In the previous chapter, we have spoke about bond valuation. Bond is actually one of the typical example for debt and for equity stocks. Okay, so in the previous chapter, we have done stock valuation. So there are two different types of stocks available. So one is preferred stock, another one is common stock. So for this particular chapter, you will probably see that the main highlight is the letter R. So throughout this chapter, you will see R a lot, okay? So in fact, the main thing that we are going to cover in this chapter is what we call the WACC, which stands for Weighted Average Cost of Capital. Or we can use this symbol, RA, to represent it, okay? So let's find out what is the R. Okay, so the entire chapter is about R, so let's look at R in general. So in this chapter, R has different names. In the previous chapter, when you learn about time value of money, probably you see this R as interest rates, discount rate, required return, and in this case, we are looking and calling this cost of capital. Are they the same? Basically, they are the same, just that we are looking from different perspective. In the previous chapter, we've been looking a lot on investment, and we are looking from the perspective of investor. So this R is mainly referred to as return. But if we were to change our perspective, if let's say who is the one who is going to give the return? Not the investor, but somebody else, the issuing company. So the issuing company, of course, when we talk about as simple as, maybe I'll put an example. So for instance, if let's say somebody say R equals to 10, what does it mean? So it depends on the perspective, which party that you are looking from. If let's say you are looking from the perspective of investor, this R would be return to that particular person. But if you were to change perspective, the issuing company, so this is no longer return for this party, but instead this is a cost. Or in other words, there will be a transfer of in exchange of the funds given by the investors, they have to pay for the cost. Okay, so this same, are we looking at the same 10%? Yes, just that for investor we call that return, but not so much for the issuing company. For issuing company, this is a cost for the fund. Okay, so let's go back to our discussion over here. So let's talk about the equations. For cost of debt, it's very similar to how you did for your yield to maturity. So in order to find the cost of debt, you have to find out what is the yield to maturity. But for me, I would suggest if you don't have financial calculator, it may be a bit challenging because you will have to go for trial and error. So I would suggest, if let's say we encounter this, you just remember that we use RD equals to I plus 1000 minus ND over N. Okay, I think I'll just drop this off. Okay, over 1000 plus net proceed over 2. And we have a name for it. This is what we call the cost of debt. But it's before tax. Okay, so just take a note. RD is actually before tax cost of debt. But if you can recall, it's very important that we have to identify what is the after-tax cost of debt. So we can use symbol RI to represent it. So in order to find it, you will have to get the before tax. So I mean to say 1 minus the company tax. Okay, and this is what we call the after-tax cost of debt. Okay, all right, so this is for debt, for cost of debt. For calculation, always remember to use this after tax, okay, because the interest itself is actually tax deductible. All right, so done with that. How about the cost of preferred stock? And also the cost for common stock. It's not a problem. So if you can recall from the previous chapter, before we go into that, when we do stock valuation, there are 3 models, either zero growth, constant growth, or multiple growth, non-constant growth. For preferred stock, normally you can use the zero growth model. So if you can recall, you may use another color. So if you can still recall from the previous discussion, for zero growth model, it looks something like this, isn't it? For constant growth model is R minus G. So again, like what I've said in this particular chapter, basically, if you know about bond valuation and also stock valuation, understanding this chapter is not a problem at all. What is focused here is basically the same, just that it's different formation. Instead of looking from the perspective of investor, like what I was telling you just now, in this case, we are focused a lot more on cost. And let's detect where we can find the R. So of course, the first R is here. You can see it here as well. But like I will say, we have to use the after-tax cost of debt. And where can we spot R in this case? I think you can see over here and over here. So basically, we are using the same formula, rearranged it to find what is the R. So let's look for R. In this case, if I were to solve this, I'll bring this over here and this over here. So my R would be now equals to D minus P. Okay, and as for this, again, I can just solve it. So in that case, my R would be equals to D1 plus G. So, and that's the R for preferred stock. So we can use the symbol P, or we can use S for common stock. So that's the formula. Okay, but there will be some adjustment needed to be done because from issuing company perspective, we don't receive the full price, right? The cost, what we call the flotation cost, there will be something called flotation cost involved. So who is going to bear all this cost? The issuing company. So basically, we don't receive the full amount. Normally, it's after the deduction of flotation cost. So we only get the net proceed. Okay, the net proceed. Same goes to here. But it depends. If let's say you are using if let's say we are using the retained earnings, then of course we can use this formula. But if it is not retained earning, we are issuing new stocks, then we have to do some adjustment. In that case, it shouldn't be PO anymore. It should be net proceed from the new stock. Okay, so this is only for new stock. Okay, so if you understand this concept, then we can just bring these two formula into here. So in other words, if you were to look into the cost of preferred stock, the formula shall be the one that we have discussed just now, D over R. And as for common stock, it can be either two. It's either we are using, let me just, okay. It's either, if let's say we are using the retained earnings, and it's slightly different if let's say we are using a new stock. Okay, so if that's the case, then for retained earnings, the cost of common stock would be D1 over P0 minus plus J. As for new, it would be, we have to do some slight adjustment. In that case, the net proceed. Okay, and that's the basic concept for the cost of debt and also the cost of equity. But if you were to look into a larger picture, so as mentioned earlier, this is the main top highlight, okay, for cost of capital. So you have to know what is WACC. So if you were to put into the formula, it should be something like this. So RA, depending on the weight of debt and the cost of debt. So it's more like finding an on average, okay? So it depends on the proportion. And also just to keep things simple, I'll just put equity in general, okay? So if that's the case, then this is the formula for WACC. But what is this W means? This W, we know about R. RA stands for weighted average cost of capital. RI is the after-tax cost of debt. RS is the cost of equity. But what is W? W here is, or in other words, is actually an acronym for weight or proportion. So in order to find this, then you have to know how much we rely on debt and equity. So to keep things simple, maybe just for an example, let's look here. So if let's say we have the company wants to raise a fund of maybe let's say $100,000. So the question here is, how do they get it? How do they get the financing for $100,000? So they have two options. They can either borrow or they can raise it from their shareholders. So if let's say they go for the borrowing option, this would be in the form of debt. From the shareholders, this would be in the forms of equity. Okay, so let's say just a very simple example. What if half of these funds I actually maybe 50,000, I got it in the form of borrowing, another 50,000 in the form of equity. So if I plus these two, it will give me 100,000. So the question here is, so how much, or in the percentage, how much proportion of debt contributing to the total amount here? So I think for simple maths, we will have 50,000 from the debt over 100,000, right? Or in other words, this figure over this, it will be 0.5. Same goes to here. Okay, so if let's say we were to calculate, then this would be the proportion. And as simple as that, this is what we call the W, the weight. So if the weight refers to debt, we can use I as a symbol, and the weight for equity we can use S. Let's say another example. What if instead of let's say instead of 50-50, how about if let's say we rely more on debt, say 70, and the remaining balance 30? So is that the weight going to be changed? Of course it will change. So in that case, then we'll have to do the calculation again. So in this case, would be 0.7. Let me just change this. So in that case, then instead of 50 just now, so 70% is actually got it from that, and 30% from here. One more example. What if instead of having more debt, we have more equity? say 60-40. So how much is the proportion in this case? I think by now you should be able to know the weight would be 40,000 based on this, then 40%, 60% from here, or in other words 0.4, 0.6 from equity. And this is what we call the weight. Okay. So in order to calculate cost of capital, it's not that difficult if you have the weight percentage here, okay, or the weightage. So if you've got the weightage, then together with the cost, you should be able to get the WACC pretty much very easily. So before we go into this final formation, let's go back to the example that I showed you earlier. And let's revert back to the original example like what we did just now. If let's say we want 100,000 and we finance equally, so in other words 50,000 from in the form of debt and another 50,000 from equity. So our proportion here would be 0.5 and this is 0.5. Let's say the after-tax cost of debt, let's say, is given. After calculation, we got it at maybe 6%. Okay? And for the cost of equity, it's normally higher. Let's say it's 10%. So in order to get this 100,000, the company can go for this option or this option. Okay, so in this case, they have combination, half from debt, half from equity. So if this is the case, what is the WACC? In order to solve that, it's quite straightforward. So if let's say 6% is needed for cost of debt and 10% is for cost of equity, so half is actually financed by debt. So I think without calculation, in this case, I think I can tell should be 8. Why is it 8? Because only half we are using the debt. Okay, so half of this plus another half for the cost of equity. So if let's say you were to find what is the expected value on this case, or in other words, the cost weighted average cost of capital, so half 3 plus half of 10 would be 5. So if you add them up together, 8. And by the way, this is actually what we call the WACC. So if let's say all in all, when we look into this, this is basically the whole concept of cost of capital chapter. So I would love you to go and have a look and if possible try out some questions. So of course the question may not be as direct as what is shown here. So normally you'll be given a different piece of information separately, then you have to go and calculate what is the cost of debt and make sure that again it must be after tax cost of debt, and then also it depends on whether you are using the retained earnings or new stock, then you just do adjustment accordingly. So if you've got all this information, then you combine it together, you should be able to solve your cost of capital easily. So that's all from me, and thank you for watching. Happy learning.